Okay, so we are live. We back with another class of better informed investors. So welcome to everyone pulling up. Make sure you hit that thumbs up like button on your way in. Appreciate everyone for pulling up, man. Our classes are doing extremely well. We have over 3,000 students that attended the first 3 classes. I'm still waiting on a few numbers to come in for our 4th class, where we covered chapter 7 and 8. Today we'll be covering chapter 9. So shout out to all subscribers, notification gang, private stock market gang members, those follow me on Twitter, those follow me on Instagram, also channel members, as well as course students. So salute to everyone for taking the time to become a better informed investor and taking this information serious. So we're going to get a couple things set up real quick just before we dive into everything. Today should be a quicker class because these 2 chapters are a little shorter. Nonetheless, they will still be very informative. If you pay attention to the things that we're talking about, you can see if you follow any of the major news media sources that basically cover investing, this is the information that they're speaking on exactly. So this is why you want to come to these classes, get this information, become a better informed investor, and put your money to work for you in the smartest way. So just getting everything set up here on the stream, making sure all our tags and things are live. Give everyone a couple minutes to pull up in here. Make sure y'all hit that thumbs up like button as soon as you pull in. Also, if you're new to the channel, make sure you subscribe and hit that bell. Today's class will be talking about profiling manufacturing, new orders and shipments. So as you can see that this is a very important chapter. We'll be getting into this in 1 second here. Let's see who all we got pulled up on us. Drop a comment ASAP. Let me know you in the building. Salute. We got y'all pulling up ASAP. Okay, let's go. So salute to the SHIB army. Yes, as y'all can see, the chart is doing well. We were just last time I checked right around that 1133 level. Let's see where it is now if we refresh it. Okay, we still right there. But yes, SHIB is up 10% at the moment, trading at 1137. This is why you do not want to be afraid of the dip. I've been telling y'all this. When I start calling these plays like this is when you really want to tune in. When I start letting y'all know it's happening, this is when you do not want to miss a beat. This is when you do not want to miss a video because it can be detrimental, to the success that you'll see. So make sure, you got the notifications on so that way you never miss a beat. Salute to everyone tuning in right now. Make sure y'all hit that like button. Salute to Exo Shylang, Slim Jimmy. Shout out to Craig Smith. Shout out to Julia Garcia. Shout out to Midnight Crypto. Salute everyone. Pull up, pull up, pull up. Make sure you hit that thumbs up like button. So yes, we did get a whale who purchased $1.7 million worth of shiba inu. And if y'all been listening to me, their money came on top of where you bought the dip in. So they helped push our gains up even higher. And I'm believing, as we get closer to the release of Shibarium, as the market starts to settle down a little bit. Do I think the worst is over yet? No, I don't. But I think, things will begin to, move higher after we possibly wick down to our lowest levels. So the reason why I say I don't think things are over, because we still have a lot of things to price in the market. Interest rates continuously will go up. We're basically nearing that recession point. We just haven't been hearing it really like that in the media before they announce it. They're waiting for 2 consecutive quarters for the GDP to drop before they announce that it is officially in a recession. But everyday people, we're feeling it already. If you go to the pumps, go to the grocery stores, wherever you go, prices are basically going up due to inflation. So which is why we're seeing interest rates being increased to try to combat that inflation. But this this economic indicator book is definitely helping us understand how to play the market and understand what's going on as well as, you know, to expect when things will begin to turn around. So I think we may see the markets go down a little lower, but I think it will be a quick wick to the downside once it does. I don't think it's going to be something that will stay down there for, you know, or at least the lowest point. Could we stay in a bear market for a while? Yes, but I think once we hit the lowest point, it'll be a quick flash down. People will grab that dip, and then we may see prices, you know, stabilize back around these higher ranges that we're seeing, you know, now. If you pay attention, we're up 40% for the week on SHIB. So that's a, you know, a big amount. That's almost 50% gain in 1 week, you know. So if you would have bought that dip, you know, $1,000 would have been, you know, an extra $400 on there. You know, some people put $1 million. That's an extra $400,000. You can't tell me some of those people, you know, aren't happy with those returns. So let's pull up the chart real quick so that way we can, you know, have something else on the screen as well. We can track the price of SHIB. Let's go to the minute chart. Okay. Julia Garcia said holding 1 billion, just adding here and there now. Julia Garcia said press that like. Thanks, December. Slim Jimmy said the chain crazy, bro. In my Cameron voice. Appreciate you, boss. Julia Garcia said, how low do you think the SHIB dip that's coming will be? It may possibly. Now, this is not financial advice, but this is just the chart showing us that it could possibly wick down to that 5 level. And it might be quick. It might be one of the days where we see the markets hit the hardest, where it pulls down to that level, but we may see smart money step right in because they see, you know, we kind of bottomed out here. And, you know, they're waiting for that pullback to be able to, you know, just catch that ride up. So that's what, you know, I'm expecting. Could it, you know, continue from here? Yes, it could possibly, but you got to think about the rest of the things going on. You know, still pretty much a war going on, still supply chain issues, interest rates still being risen. The Federal Reserve chairman says he's gonna, you know, try to give us a soft landing, you know, basically getting the inflation under control, but it doesn't look like that's really going to be able to happen. We were first told that interest rates would be risen a half a percentage point, or 50 basis points, and we ended up seeing rates being risen, increased to 75 basis points. So 3/4 of a point. He said next month in July they're meeting again, which he can possibly do the same thing, which may, you know, the market, I believe, has kind of priced it in, but what is still uncertainty. You know, that uncertainty and doubt of what's going to happen can still cause some, you know, some volatility in the market. So let me know if the volume is working. It says on my mic that the volume is working, but we got one person that said no volume. Salute to Pamela Crum for pulling up. Shout out to Healing Helping Love for pulling up. Shout out to Tillery Mills. So, you know, there's a few platforms you can use to buy SHIB. Of course, you go to connect to shibaswap. You can buy on Coinbase, crypto. Basically, every major platform, even Robinhood now, you know, has shibainu. So Julia Garcia asks, so buy order will be smart at 550, definitely, or a little possibly. You know, let's take a look at that real quick since you're asking. See, I like when y'all start talking about buy orders because that let me know that y'all been paying attention. So right now the chart, when we go on Trading View or using CoinMarketCap, it's not showing us any. Let's see. Okay, so possibly I would say so we're seeing some support in the I would say right about the higher 5, so maybe 560 range, 5 you got to remember, they may not let it go exactly to that level, so you may want to set it just a little bit higher, maybe 580s. Even, you know, if you can catch them, you know, the 590s. But if they push it to the 590s, most likely it will touch that 580, 575 range. And the lowest point that we see, you know, really, if we really want to call it, to be safe, to make sure we're still within that candle. Let me show y'all what I'm looking at as well, so y'all can get an idea. So we're looking at this low area here in the chart, which is about 527. Just about 527 to be safe. But, you know, if you can catch it at 565, 570, 580, that's still a pretty good buy. Even if you got to set that buy order to the 6th level, because it could tap that 6th level and not even pull all the way down and turn around. So maybe you could set, you know, a couple buy orders, set some at that 5 level, set some at the 6th level. You know, if you're using different, you know, exchanges especially. But I think if it does that, it will turn around very quickly. Okay, so he said it's maybe just my laptop, bro, but I have volume on my cell phone. Might need to restart laptop. Thanks, though. Okay, so let's get into this. Salute to everybody for pulling up. We got chapter 9 today. So profiling manufacturing, new orders and shipments. So in this chapter, we'll be keeping track of orders for durable goods, reviewing factory orders, back orders, and shipments, and understanding why inventories matter. U.S. manufacturers are very sensitive to changes in the economy, more so than any other economic sector. In fact, even small changes in consumer and business purchasing behavior have a huge impact on manufacturers. One easy way to track this purchasing behavior is to watch the flow of new orders to manufacturers and their product shipments. If you've ever thought that the economic forecasting would be a whole lot easier if you could actually see into the future, you're going to like the indicators I discuss in this chapter. While most economic indicator reports what has already happened, this chapter showcases a few economic indicators that turn this model upside down by foretelling what is about to happen. They monitor the manufacturing sectors and provide economic insight that you simply can't find anywhere else. So filling orders for durable goods, that the advanced report on durable goods. To tell the economy's future, you need a great fortune teller. The advanced report on durable goods, short for the advanced report on durable goods manufacturers, shipping, inventories, and orders, is the best substitute for a crystal ball that anyone can ask for. So this is the best substitute for a crystal ball that anyone can ask for. So pay attention to this portion. The advanced report on durable goods actually can tell the future. After all, companies report actual sales orders they receive for products they'll soon have to manufacture. As a business leader or investor, you won't find a better manufacturing forecast than seeing actual sales order in hand. Note, as the name implies, the advanced report on durable goods precedes a second report called the full report on manufacturers' shipments, inventories, and orders. The full report, which is commonly called the factory orders report, includes more extensive information about durable goods manufacturing and introduces information about non-durable product manufacturers as well. I discuss factory orders report more fully in the section monitoring factory orders and sales, the factory orders report. So table 9.1 provides what you need to know to follow the advanced report on durable goods. For a copy of the release schedule, go to the website listed in the table and click on the link for release schedule, which is located in the right-hand column near the bottom of the page. So its release schedule is monthly. It's published at 8:30 a.m. Eastern Time. The agency that produces it is the U.S. Census Bureau, Department of Commerce. Their website is www.census.gov/manufacturing/M3/. Its sensitivity to the market is high. That means it has a high effect on the market. Keep that in mind. So the following sections outline how the advanced report is generated. Remember, this is all stuff you'll hear them talking about today in the news on, these major investing news platforms. So why the information in it is important and how you can use it in your investment portfolio. Knowing where the data come from. Both the advanced report on durable goods and the full factory orders report are based on the same Census Bureau survey, but the advanced report generates most of the attention because the data collected for it are fresh and the report itself is timely. Both reports cover the calendar month just completed. The advanced report covers orders and shipments of durable goods and is released 4 weeks or so after the end of the month. The more thorough full report also covers non-durable goods and is released a week later. So looking for historical info. The Census Bureau provides historical data series for both the advanced report on durable goods and the full factory orders report. It also offers direction on how to decipher the data files. Here's where to go for the data series and the direction for reading them. So historical data series is www.census.gov/manufacturing/m3/historical_data/index.html. Directions for reading historic data series is www.census.gov/manufacturing/m3/historical_data/NAICS/HIST.pdf. So although the Census Bureau takes pain to clarify that it doesn't take the survey it uses to generate the advanced and full reports from a statistically random sample, and that the survey may not accurately represent the entire U.S. manufacturing base, the reports have nonetheless proved their value. They're exceptionally good forecasting tools. The advanced report and the full report show 3 months of new order and total shipment data, along with corresponding month-to-month percentage changes. They also provide seasonal adjustments along the unadjusted data. The current month's data may be revised both in the full report and in subsequent issues of the advanced report. No adjustments are made for inflation, and the data are not annualized. See Chapter 2 for a refresher on inflation indexing and annualizing data. And for y'all that are tuned in, you can check out Class 1 for that. So make sure y'all tap that thumbs up like button. Tracking new factory orders. Why these stats are important. Although the full factory orders report is more thorough, the advanced report on durable goods creates the biggest investment market fireworks because business leaders and investors are interested in the early data. Particularly the new order durable goods statistics provided in the advanced report. This focus on new order durable goods stats makes sense because new orders drive production. Without customer orders, durable good manufacturers have little reason to keep their factories turned on. In case you're wondering, durable goods are products that are intended to last 3 years or longer. Consumer durable goods include things like trucks, automobiles, household appliances, television sets, personal computers, and furniture. Business durable goods include computer systems. Salute to everybody pulling in. Communication gear, farming machinery, factory machine tools, and transportation equipment like heavy-duty trucks, ships, and airplanes. The U.S. government also buys durable goods from U.S. manufacturers. Government durable goods include office equipment and specialized equipment for the military like submarines, tanks, and fighter jets. Non-durable goods, on the other hand, are things you can use or consume regularly. Consumer non-durables are sometimes called consumer staples. If y'all remember, we talked about that in the first class, and include food, beverages, pharmaceuticals, clothing, soap, laundry detergent, and other household products. In the business world, office supplies like paper, pens, and paper clips are non-durables, as are manufacturing supplies like lubricant, paperboard, containers, pesticides, fertilizers, and most petrochemical products. New orders for manufactured goods, especially durable goods, offer an excellent forecast for future manufacturing activity, which in turn offers a general forecast of where the economy is heading. Companies buy durable goods only when they're confident that their businesses can justify the expense based on their prospects for future growth. That's why the new order stats in the advanced report on durable goods are so compelling to investors and business leaders. An increase in the value of new orders is usually a sign that businesses and consumers are feeling more confident about the economy. Conversely, a decrease in the value of new orders is often a sign that the economy is heading for a slowdown. Remember, now, I'm not saying that non-durable goods are unimportant. They're actually quite important. In fact, non-durable goods represent about half of the U.S. manufacturing output. However, the purchase and production of durable goods are much more sensitive to the economic climate and thus are much better economic indicators. Consumers need to regularly buy non-durable products like food, medicine, and clothing regardless of the current business cycle. Although they may substitute less expensive non-durables during times of economic stress, consumers can completely forego durable good purchases whenever they're anxious about the economy. So they're basically announcing, or stating why, consumer staples, those products that are meant to be reused, or that last less than a 3-year period, people buy those regardless of how the economy is doing. So it's hard to use those as indicators as, economy performance. But durable goods, those things that are meant to last, 3 years plus, the big purchases, the things that are not impulse buys, something that people have to really, sit down and make a decision on purchasing. those things, are a bigger factor, in determining the health of the economy, because you can start to use it as an indicator to determine, are people slowing down these purchases? Are people increasing these purchases? Which that is generally a sign of how the overall country, believes the economy is doing. So figuring out what the data mean. The advanced report on durable goods provides valuable information that you can use as an investor. However, you can't take full advantage of the report if you don't have a firm understanding of what the different categories in the report mean. This section explains the different sections on the report. Figure 9 shows an excerpt from the advanced report. Specifically, the excerpt shows table 1 of the report, which provides the new order and total shipment data. So I'll show y'all this so that way y'all are familiar with what this report looks like, but y'all can look up current reports to see, the most up-to-date ones. So this is called the Durable Goods Manufacturers Shipment and New Orders Report. So here's what that looks like. Again, don't get too caught up on it. Just want to show y'all. You can pause it, come back to this, later if you really want to, see what this one is, or look up the most current one. But let's keep going. Salute to Oz. Shout out to Blaz. Shout out to Kelvin Melendez. Shout out to Lee Figueroa. Salute to everybody pulling up on the stream, man. Y'all are taking this serious and it will pay off. So, as you can see in the figure, table 1 subdivides manufacturers into broad categories like electrical equipment manufacturers, transportation equipment manufacturers, and machinery manufacturers. Each of these broad categories show both new orders and shipments for the current month and the 2 previous months. Here's what these 2 terms mean. So new orders for the current month, the new order data includes all orders received during the month minus any cancellations. When the order is scheduled to ship, doesn't matter. It could ship in the current month or any future month. So shipments. The shipment data is the total value of all completed sales of durable goods during the reporting month. Generally, companies report actual product shipments to customers or distributors. However, in the case of sometimes very large products like aircraft or military equipment, the report is based on manufacturer provided estimates of the completed work instead. So most of the categories shown in figure 9.1 are self-explanatory. However, several of them may require a little clarification. So total new orders. The headline number for this report is the total value of durable good orders received during the month minus any order cancellations. It doesn't include the capital goods category, which I discussed later in this list. So because month-to-month percentage changes can be very large, figuring out the underlying trend may be a little difficult. Check out the next section for several ways to deal with this volatility. Total new orders excluding transportation. Although all durable goods components exhibit some volatility, the transportation sector exhibits very large swings in the value of new orders. This instability isn't surprising at all. Commercial airlines don't order new airplanes every day. When an airline enters an order for jumbo jets, you see a very obvious change in the total value of new orders. So to give you a more stable picture of new order totals, this category on the report subtracts civilian transportation equipment and non-defense government transportation equipment from the total new orders. Total new orders excluding defense. Government defense equipment also causes some pretty big swings in the value of new orders. The Pentagon doesn't order new submarines or fighter jets every day. When it does, you see large spikes in the total value of new orders. This category of the report removes these spikes from the total new orders calculation. We also have capital goods. The capital goods category, which you see near the bottom of figure 9.1, shows the data that have been recategorized from other sections of the report. The total value of new orders that you see at the top of the table in figure 9.1 doesn't include the data shown in this category. If it did, the data would be counted twice. In case you're curious, capital goods are the goods that businesses use to manufacture other products or services. Examples include factory machine tools, mining and oil drilling equipment, power distribution equipment, and transportation gear such as automobiles, airplanes, and railroad equipment. Non-defense capital goods. This subcategory of capital goods is also called core capital goods. It removes all defense production from its data. Non-defense capital good data are an excellent business spending indicator. Historically, the indicator begins to slip months before the economy shows signs of slowing. So table 2 from the advanced report follows the same format as shown in figure 9.1, but it lists order backlogs and inventories. Here's what these 2 terms mean. So unfilled orders, also known as the order backlog. Unfilled orders consist of all orders that the manufacturer haven't been able to produce yet. When factories are so busy that they can't produce enough to meet all the orders they receive, look for future economic growth. Large backlogs lead to job growth and eventually to companies increasing production capacity. However, delivery delays for manufacturing components cause production bottlenecks at other manufacturing facilities. Delays can also lead to price increases and eventually to inflation. So, we're seeing, delays with supply chain shortage issues as well. So this kind of plays out with what we're seeing today. So total inventories, finished goods inventories grows when manufacturing facilities produce more product than what they sell. Growth in total inventories often precedes an economic contraction. Correlating manufacturing and future growth. The new order section of the advance report on durable goods offers an exceptionally good look into the economic future. Even better, its forecasting ability isn't limited to durable goods manufacturers alone. It also does an admirable job of forecasting the economy as a whole. Calculating total new orders minus defense and transportation. So the advanced report on durable goods contains all the data you need to calculate the total value of new orders without defense and transportation spending. But you have to perform the calculations yourself. Use table 1 of the advanced report and follow these steps to calculate this new statistic. So subtract the excluding defense new orders value from the total new orders value to figure out how much was spent on total defense. So total new orders excluding defense new orders equals the total new orders for defense. I'll show y'all this equation, also this formula, so y'all can write it down or just see what it looks like. So subtract the excluding transportation new orders value from the total new orders value to figure out how much was spent on total transportation. So total new orders excluding transportation new orders equals total new orders for transportation. So subtract the total number of orders for defense, TD, and the total new orders for transportation, TT, from the total new orders to calculate the value for new orders of core durable goods. That is all durable goods except defense and transportation. So total new orders minus TD, which stands for total defense, total new orders for defense, and then TT minus TT, which is total orders for transportation. So equals the total value of new orders for core durable goods. So keep a running total of this statistic to help you monitor the core new order values without the volatile defense and transportation sectors. So this is what this formula looks like. Again, y'all can pause it here if y'all would like, but I don't want y'all really to get too hung up on figures. It's really about being, exposed to this information, taking in what you can, figuring out your favorite indicators, determining by, what the book is telling us, which ones affect, the markets with the most severity. Those are the ones you really want to pay attention to. So remember, unfortunately, the month-to-month changes in the new order statistics are often volatile due to the limited number of orders and huge costs associated with some large durable goods like aircraft orders and defense equipment. The total new orders value can change dramatically from one month to the next. This section offers several techniques for dealing with this volatility and figuring out the underlying trend of the new orders value. Figure 9.2 shows just how volatile new order statistics can be. The spiky up and down lines on this chart represent the month-to-month percentage changes of the total value of new orders. Reading above the center line means that the value of new orders increased from the previous month. Readings below the center lines means that the value of orders decreased. So obviously you need to smooth out this data to see whether new orders are actually trending higher or lower. You can use several techniques to do so. So remember, we can use a moving average. You can remove some of the month-to-month volatility by using a moving average. See chapter 2 or our class number 1 for a refresher on how to construct a moving average. A 3 to 6 month moving average allows you to more easily see which way the value of new orders is trending. Figure 9.2 shows a 6-month moving average. As long as this moving average is above the center line, the average value of new orders is increasing. Take a yearly analysis. You can also look at the year-over-year changes in the orders instead of focusing on the month-to-month changes. Fortunately, the advanced report on durable goods includes year-to-year comparisons as part of the data. This isn't seasonally adjusted as shown in figure 9. So exclude defense and transportation. You can also remove some of the volatility by removing the most volatile components from the new order statistic. Doing so isn't difficult, but you do need to sharpen your pencil a bit to perform the necessary calculations. See the nearby sidebar calculating total new orders minus defense and transportation for details. You can also combine this technique with either a moving average or a year-over-year comparison to get an even better sense of the trend for new orders. So here's that figure right here. Manufacturing your portfolio response. Increases in new orders for durable goods are generally favorable for stocks and unfavorable for bonds. Conversely, decreases in new orders and for durable goods are often greeted with selling by stock investors and with enthusiasm by bond investors. The following section breaks down how different investors can use the advanced report on durable goods. Remember, because month-to-month changes in the advanced report can be extremely volatile, investors often have a hard time figuring out what's actually happening. So make sure that you find the underlying trend. As I discussed in the preceding section, before you make any rash investment decisions, looking at moving averages is helpful, but the best way to find the underlying trend is to look at the core changes in new orders, excluding transportation and defense orders. Watching the bond market's reaction. Bond market investors often worry about the effects of inflation on their bond portfolio because rising inflation harms the total return on fixed income investments. Bond prices fall, interest rates rise, and inflation diminishes the value of the future payments. Likewise, bond market investors worry when the total value of new orders for durable goods rises because rising new orders may presage rising inflation. On the other hand, bond investors generally relax when new orders fall. So a tip: when the value of new orders persistently rises, shorten the average maturity of your bond portfolios. When the value of new orders shows a sustained downward trend, lock in lower priced bonds with higher yields. So, seeing how the stocks react. Stock investors like to see the value of new orders for durable goods increase. They interpret a decrease in value of new orders for durable goods as a sign of poor economic health because it will ultimately harm corporate profits. Stocks of manufacturing companies are usually the hardest hit as new orders trend lower, but you can expect the effect to quickly cascade into unrelated industries. So here's another tip. The health of manufacturing sectors is usually a good barometer for the economy and the stock market as a whole. As the value of new orders for durable goods begins to trend higher, start moving out of lower risk fixed income investments into growth stocks. When the trend reverses, start paring back your exposure to growth stocks and begin moving to more conservative investment positions. So like, the OG cryptos, Bitcoin, Ethereum, OG stocks are what they call blue chip stocks, Amazon, Walmart, some of these companies that will be around for years to come. So, well, actually, let me take back Amazon because that would technically fall in a tech category. But, stocks like Walmart, Target, things that'll be around that offer a lot of these consumer staples, those stocks will be good to take a look at during this time. So, knowing how to react if you invest in commodities. Industrial metal traders carefully watch the primary metal sector in the advanced report on durable goods. The advanced report shows an aggregate value for new orders for iron and steel mills, aluminum and non-ferrous metal foundries, and ferrous metal foundries. Futures contracts exist for many of these metals, including aluminum, nickel, copper, uranium, and steel. A futures contract is a standardized buy and sell agreement specifying the product quantity, quality, delivery date, and delivery location. See Chapter 15 for details. So, of course, precious metals like gold, silver, platinum, and palladium are also used in manufacturing electronics and automobiles and are actively traded in the commodities markets. The exchanges where futures contracts are bought and sold. So here's another tip. Rising new orders for durable goods often drive commodity prices higher. For people who invest in commodities, a trend toward higher new order values marks a good time for long positions in these commodity markets. Conversely, a trend toward falling values may depress the prices of industrial metals and may represent a good time to sell or short the product. In traders lingo, a long position means that you take ownership position in that product in the hope of selling it later for a higher price. A short position is the opposite of a long position. Traders short a commodity by selling first in the hope of buying it back at a lower price. So observing the effect on currency. The value of the US dollar is directly related to the strength of the US economy and US interest rates. Rising values of durable good orders often precede strength in the US dollar. Falling values often precede weakness. Salute to Kofu Blue. Shout out to all the new students pulling into class, pulling up a chair. Shout out to Humble Reminder. So at a birthday party, but I wanted to say, even though I'm not present, I'm aware and will be in class on the replay. Appreciate you, DeMarco, and love y'all in the community. Salute to Humble Reminder. Happy birthday to whoever you with. Wish them a happy birthday for me. Shout out to Virtual Citizen. Said 100 million sheep. Diamond hands here. Salute. Say, we got Josh in the building. He said, here, bro, after a long work week, 13-hour days. That's what's up, man. That's what I'm talking about. Right now is the time to be putting in those 60 hours, more hours if you can, developing a side hustle. And I also got something very special for those looking to develop the skills to be able to create a side hustle, because I've been telling y'all that right now during the down market is the time to accumulate more cash, so that way you can take advantage of these discounts before the prices turn around. And I was telling y'all to develop some skills. A lot of people said they only had certain things that they felt that they could do, or they would like the opportunity to develop some more skills. So I got something for y'all. Stay tuned. So see where we are. Shout out to General Scarborough, just pulled up, said holding, not folding. Shout out to Essence, said tapped in, always pulling up. So salute. So, observing the effect on currency. The value of the U.S. dollar is directly related to the strength of the U.S. economy and U.S. interest rates. Rising values of durable good orders often precede strength in the U.S. dollar. Falling values often precede weakness. So, monitoring factory orders and sales. The factory orders report. The factory orders report follows 1 week behind the advanced report on durable goods. It reports similar information, new orders, shipments, back orders, and inventory, but in much more detail and for a broader base of U.S. manufacturers. Formerly called the full report on manufacturers, shipments, inventories, and orders, the report includes revisions to the advanced report along with more extensive information about durable goods manufacturers. In addition, it also provides information about non-durable manufacturers. So Table 9.2 gives you the info you need to follow this report. So Table 2 shows us that the monthly release schedule, or the release schedule is monthly. It's released at 10 a.m. Eastern Time. The agency that releases it is the U.S. Census Bureau, Department of Commerce. Their website is www.census.gov/manufacturing/M3/. And the sensitivity to the market is low. So the factory orders report doesn't move investment markets like the advanced report does. However, the detail you get from reviewing this report is well worth your time. The following sections take a closer look at this report and highlight what you need to know about it. So to some technical stuff. The U.S. Bureau of Economic Analysis, or BEA, uses the factory orders report data when compiling the gross domestic product, GDP report. See Chapter 7 or Class 4, I believe that is, for more about BEA and GDP. Also, the Conference Board includes a new orders value from this report when calculating its index of leading economic indicators, or LEI. See Chapter 10 for more details. So comparing the full and advanced versions. Figure 9.3 shows Table 1 from the factory orders report. The table shows the value of manufacturer shipments by industry groups. To get a sense of the detail provided by the factory orders report, compare Figure 9.3 with Figure 9.1 from the advanced report earlier in this chapter. Instead of including only a single entry for shipments under each broad manufacturing category, the factory orders report shown in Figure 9.3 provides a lot more detail. For example, where the advanced report shows a single value for machinery shipments, the factory orders report expands the machinery category into 9 subcomponents. So here's that figure here. Y'all can take a look at. Again, don't get too caught up on it. Just take a look. If you want to look up the most current one, it is called the Value of Manufacturer Shipments for Industry Groups report. So you can Google this. And again, this is meant to help y'all when we're taking in some of this information on these major news sites on what the economy is doing. Now you know what this stuff means. Now it's not just info that's just bouncing out one ear through the other. You can actually understand what some of these reports mean and the effect that they have on certain investments. You can also understand how investors will react to this information by knowing these reports. You also understand which of these reports have the most severity and affect the markets the most. So shout out, we got a new channel member. Shout out to XO Shy Lang. Appreciate you for pulling up on us as a channel member. Salute to all of our channel members. If you want to become a channel member, click the button down below. You get special perks, special access to members benefits onlys. We do some members only live streams, as well as this content that you are watching right now will only be available for members in a short period of time. So content like this, members only live streams, and also a lot of other things that is back there for y'all. Tap into that to get access. There's a link in the description that says join members, or there's a button along the screen somewhere, probably at the bottom, or if you're on the phone you may have to click around to open it up to actually see. So if you want to become a channel member, take the moment to do that right now so I can shout you out. But let's keep going. So here's that report. Again, it's kind of small, so just get an idea of what's there. You can see how it looks. It's going over some of the industries. It says all manufacturing industries, excluding transportation, excluding defense, with unified or unfilled orders, durable good industries, wood products, non-metallic mineral products, primary metals, iron and steel mills, aluminum and non-ferrous metals, ferrous metal foundries, fabricated metal products, machinery, farm machinery, construction machinery, mining, oil field and gas field machinery, industrial machinery, photographic equipment, ventilation, heating, air conditioner and refrigeration equipment, metalworking machinery, turbines, generators, and other power transmission equipment, material handling equipment. So these are some of the things that are covered in the value of manufacturer shipments for industry groups report. So let's keep going. Josh says, most definitely, bro. I sacrifice now. I know it'll be worth it. 100%, bro. So you find the same expansive detail for all the categories shown in the advanced report, in addition to the shipments data. The full factory orders report details new orders, table 2 back orders, table 3 inventories, table 4, and a whole lot more. Additional tables from the factory orders report, table 5, topical series. Topical series are regroupings of the separate industry categories shown in table 1 through 4. Table 5 regroups shipments, new orders, inventory, and back orders. The most important value in these topical series is the regrouping called new orders, non-defense capital goods excluding aircraft. A strong correlation exists between the new orders, non-defense capital goods excluding aircraft topical series and the future economy. A decline in this new orders topical series usually precedes an economic downturn, while an increase often precedes economic expansion. The shipments topical series is also worth a quick look because the BEA uses it to calculate the capital investment component of GDP. So table 6. Inventory valuation by stage of fabrication. This table categorizes inventories as being raw materials and supplies, works in progress, or finished goods. Changes in inventory levels can help you spot economic changes. Inventory buildups often precede economic downturns. Declines often lead to future growth. So let me say that again. Inventory buildups often precede economic downturns. Declines often lead to future growth. So that's in the inventory valuation by stage of fabrication. Table 7, we got ratio of shipments to inventories and unfilled orders. Table 7 clarifies the relationship between backlogs, shipments, and inventories by showing two ratios. The first, the inventory to shipment ratio, show the relationship between current inventory levels and completed orders. The second shows the ratio between back orders and shipments. I discussed the inventory to shipment ratio more fully in the section Counting Business Inventories, the Manufacturing and Trade Inventories and Sales Report. Shout out to John Wick for pulling up on us. He said, what's up, my people? So we got table 8, revisions to previously published monthly changes. This table shows revisions made to shipments, inventories, new orders, and backlogs from previous releases of the full factory orders report. This table tends to show very small changes from release to release. Investing in the full report. Although the factory orders report rarely moves investment markets, neither business leaders nor equity investors should ignore it. Careful analysis can provide insight into early trends for the whole economy, as well as for specific industries. Information in this report can help pinpoint trouble or opportunity in manufacturing industries well before other reports, so keep that in mind. For example, a fall in new orders is a clear sign that customers may be losing their appetite for a company's products. You can make the same conclusion as inventories start to rise. Conversely, rising new orders, rising back orders, and falling inventories correspond with growing businesses. Again, let me say that. Rising new orders, rising back orders, and falling inventories correspond with growing businesses. But the opposite, when we got inventories piling up, that's a signal that, you know, things are in a downturn. So counting business inventories, the manufacturing and trade inventories and sales report. Although information about manufacturers' inventories is available in the factory orders report that I discussed in the preceding section, that report is missing one crucial piece of data: the inventory positions of the manufacturer's customers, usually retailers and wholesalers. So the only insights into the manufacturer's customers that the factory orders report provides are the new order statistics. While those stats are useful to an extent, knowing how the manufacturers, distributors, and retailers are handling their inventories is also important, because the inventories have a direct impact on manufacturers' future business. Although computerized ordering systems and just-in-time manufacturing have helped companies better manage inventory levels, inventory problems still confound business management and regularly impact the economy. When consumers feel anxious about their financial well-being, they buy less. Inventories pile up in distribution centers and on real. Let me say it again. When consumers feel anxious about their financial well-being, they buy less. Inventories pile up in distribution centers and on retailer shelves. That's where the manufacturing and trade inventories and sales report, also known as the business inventories report, comes into play. This report looks at inventories across a wide business spectrum and shows inventory levels for manufacturers, wholesalers, and retailers. Table 9.3 provides more insight into this report. So Table 9.3 shows us that the release schedule is monthly, 10 a.m. Eastern Time. The agency that releases it is the U.S. Census Bureau, Department of Commerce. Their website is www.census.gov/MTIS/ and its sensitivity to the market is low. So the business inventories report is only 3 pages long, and some of its information is dated by the time the report is released. For example, the factory orders report, which I discussed in the preceding section, provides the same manufacturer's inventories as business inventories report, and that report is released 2 weeks before the business inventories report. However, the business inventories report does provide some. Let me say that again. However, the business inventories report does provide some important new information about retail inventories, including the essential inventory to sales ratio, or called the IS ratio. So the IS ratio tells you how long businesses would take to sell all their inventory. For example, if the ratio is 1.25, businesses would take 1.25 months at the current sales pace to sell everything they have in inventory. Figure 9.4 shows us the aggregate IS ratio for U.S. businesses. So you can take a look at this here. We see on average it's around, of course we would have to develop a moving average, but we see a high of 1.5 to a low of almost just below 1.25. So I'll show y'all what that looks like. Total business inventory sales ratios. So you could pause it there, or look up the most current one to see what that's looking like. Salute to everybody in the stream. Make sure you hit that thumbs up like button, and I want to say congratulations for taking your education serious, and I guarantee you this will pay off. Your next 60 to 90 days will be completely different from this point if you continue to take this information serious. And you got to really soak it up, so that way you really get something from it. If you pour in, there's no choice but for something to, you know, come out of that. So, you know, let's keep it rocking. So before 2001, the IS ratio for all businesses averaged about 1.45 months. As you can see from figure 9.4, the ratio in 2010 stayed below the 1.3 level. Notice that the IS ratio spiked to 1.54 months in 2008. Recall the very large recession that coincided with that inventory peak. So you might want to take a look at current inventory peaks as well. So it took more than a year for businesses to work through that inventory increase. The business inventories report also includes IS ratios for manufacturing, wholesale, and retail sectors, and shows IS ratios for different kinds of businesses, such as food and beverage stores, department stores, and durable goods retailers like motor vehicle and parts dealers and furniture dealers. Y'all, this information is so fire. These are straight gems. You know, this is information that you most likely literally have to go to college for. So for the fact that y'all are able to get this information in the stream is very, very powerful. So if you haven't yet, make sure you hit that thumbs up like button, you know, to show, you know, that y'all are rocking with me and y'all appreciate this type of content, because, you know, there's a lot of people might find this type of stuff boring, but this is what it really takes. You know, this is what it takes, you know, going to the gym and, you know, exercising our minds and really, you know, becoming better informed investors. You know, also subscribe if you haven't, turn on notifications as well. So salute. Shout out to all the new people that just pulled in. Make sure you drop a comment. So let's get it. So here's one last tip in this chapter. The IS ratio provides a very early look into the problem areas within the economy, sometimes before these problems show themselves in the factory orders or advanced durable goods report. Even though the business inventories report is a low profile indicator with little investment market impact, both investors and business leaders are wise to monitor it. So they're telling us, you know, how these different indicators affect the market. And even though some of them have little, you know, little effect on the markets, they're still important because they give us insight to other things that are about to happen in the market and how to position and prepare for them. So that's chapter 9. We got chapter 10 right here. This chapter is a little bit shorter. It's only a couple pages here, y'all. So I don't know. Depending on how we feeling at the end of this one, we might could squeeze another chapter in, because this one is literally like super short. Shout out to Blast, always pulling up. So, chapter 10, grappling with economic indexes. In this chapter, surveying purchasing managers, looking into service industries, indexing leading economic indicators. This chapter wrestles with 3 economic reports that try to represent monthly economic conditions by using a single easy to understand index value. Surveys of purchasing managers form the basis of 2 of the 3 reports. These survey-based reports show the current state of the manufacturing and service sectors, respectively, and provide near-term business activity forecasts. The third report consolidates economic information from existing indicators to create a new way to look at the current state of the business cycle. These business and economic indexes provide a quick and easy way to track the current state of the economy and get a glimpse into its future course. Measuring ISM's manufacturing survey. If you've ever worked in a large company, you know that the purchasing manager makes formidable adversaries at the negotiation table. Even if you don't have that first-hand experience, you may know that purchasing managers are important people. They have a unique vantage from which to grasp the current condition of their company's business and supply chain, a viewpoint that helps them forecast the economy. The purchasing department orders everything a company needs, from office supplies to manufacturing equipment and the raw materials necessary for production. Purchasing agents keep up with the new customer orders. They make sure that the facility has sufficient inventory of production material to keep facilities operating on schedule. And purchasing agents are knowledgeable about commodity pricing, the availability of manufacturing supplies, and delivery times for all the new raw materials used in production. Each month, the Institute for Supply Management, or ISM, surveys purchasing managers about the current condition of their businesses and their experiences in the marketplace, and publishes 2 reports. Economists, business leaders, including purchasing managers, and investors widely follow the first report, the Manufacturing ISM Report on Business, or ROB, which I discuss in greater detail in the following sections. The second survey-based report is the non-manufacturing ISM report on business, which I discuss later in this chapter. The reports are easy to interpret and timely, and they provide more insight than production reports alone. So Table 10 gives a quick overview of the manufacturing ISM report on business, which is a monthly release date on the first business day of each month at 10 a.m. Eastern Time. The agency that releases it is the Institute for Supply Management. Their website is ism.ws/ismreport/index.cfm, and its sensitivity to the market is high. So that is the manufacturing ISM report on business. You definitely want to keep an eye on that one and pay attention. Salute, shout out to everybody. Pat Vision just pulled up on us, said I just pulled up, but I'll watch the replay to catch what I missed. Okay, salute. We definitely just dropped some gems in this stream. We dropped some extremely fire gems, and I don't mean to keep saying it like those that are already tuned in don't understand, but we got some people that might just breeze past and not understand the importance of this because it may not sound as exciting as some of the other information that we get on the channel. So definitely want to subscribe for this type of information. Literally dropping gems here. So understanding how the ISM surveys purchasing agents. The manufacturing ISM report on business is a collection of information about manufacturers and their supply chains. Each report provides a performance summary by industry and anecdotal reports from the survey's respondents, a section about commodity pricing and availability, and indexes for a variety of business measures. The indexes get all the attention in one specific index, the PMI, which used to be called the Purchasing Managers Index, but is now known only by its initials, is the most attractive of all. The ISM selects companies that represent the industry and geographic distribution of U.S. manufacturers for its surveys. This selection process means that large industries such as auto manufacturing and its supply chain have more representation in the survey than smaller industries. The survey question that form the basis of the index all take the same form and call for respondents to answer in one of the following ways: either better, worse, or the same, or increase, decrease, or no change. The ISM converts the responses to each question into a diffusion index, an index that shows how far responses spread away from the center. See Chapter 2 or Class 1 for a primer on diffusion indexes. So remember, ISM diffusion indexes include the PMI are reported on a scale that ranges from 0 to 100. The diffusion index shows 50 as their midpoint. If an index is above 50, more respondents answered the survey question with a response of better or increasing compared to those who answered with worse or decreasing. A value below 50 means that more people answered by saying worse or decreasing. So checking the health of manufacturers. The ISM indexes that appear in the manufacturing ISM report on business are good indicators to foresee changes in the gross domestic product and to identify changes in the business cycle. Each index identifies the direction of the current trend and any change to the trend. Unfortunately, these indexes provide little information to help you identify the magnitude of the trend or trend change. So they help identify, the direction of the current trend, but it doesn't help with the magnitude. So here's a brief description of each index. PMI, the former Purchasing Managers Index, serves as the headline index for manufacturing ISM report on business and provides a good overview of the manufacturing sectors. It's an aggregate of 5 ISM indexes. I discuss the PMI index more fully in the next section. So New Order Index measures the change in order quantities from the preceding month but doesn't measure differences in prices paid by the customer. Rising values for the New Orders Index generally indicate that rising production and a growing economy will follow. Production Index reports production levels compared to the preceding month. As with New Orders Index, rising values in the production index usually precede increases in the economy as a whole. Employment Index reports the rate of increase or decrease of overall employment levels compared to the preceding month. The employment index may foretell changes in the employment situation report, Chapter 4 or Class 2, but it's linked more closely to manufacturing industries than to the general economy. Shout out to 49KT Real Gold. Say keep it up, DeMarco. You the GOAT, bro. Appreciate you for pulling up on me, bro. Shout out to everybody taking this serious, man. It will pay off. Your next 60 to 90 days will be different if you continue to take this information serious. Do not shortcut yourself. Do not cheat yourself. Treat yourself to this information. Trust me, it will be worth it. So, Supplier Deliveries Index shows whether suppliers are delivering production materials more quickly or slowly compared to the preceding month. An index above 50 represents increasing delivery times. If delivery issues are due to increased demand and tight supplies, the situation may lead to higher prices and eventually to inflation. The Supplier Deliveries Index is part of the Conference Board Leading Economic Index, which I discussed later in this chapter. So, Inventories Index measures the increase or decrease in manufacturers' inventory levels compared to the preceding month. Increasing inventory levels often signal slowing sales. Customers Inventory Index measures the inventory levels of manufacturing customers. Lower values often lead to an increase in new orders and a future pickup in production. Prices Index reports rising or falling prices for raw materials and other inputs to the manufacturing processes. Increases in the indicator may lead to consumer product price increases, which can eventually lead to inflationary pressures. This index may also be useful for identifying deflationary scenarios. However, that has yet to be confirmed in the real economy. So, Backlog of Orders Index reports whether order backlogs are growing or declining. Rising backlogs usually precede production growth and growth in the general economy. New Export Orders Index measures the level of orders or services to be provided outside the United States compared to the preceding month. Export growth is often a sign of a growing economy, but it can also be driven by a weak US dollar. Imports Index measures the rate of change for raw materials imports compared to the preceding month. Normally, import growth occurs during periods of strong economic growth. A strong US dollar may make prices of imported products more attractive than domestically produced materials. The report on business provide additional details about each index, including a short summary that tells which industries reported growth or declines, along with a chart showing the recent history for each index. So see figure 10.1. The summaries help business leaders, policy analysts, and investors pinpoint areas of strength and weakness in the U.S. economy. So here's a quick glimpse of all those of the ISM report on business and the different sections or categories that it covers. Remember, you can always look up the most current one if you want to, get more information on this. So, surveying purchasing managers' insights for the PMI. The PMI is ISM's headline index. Its predecessor, the Purchasing Managers Index, was first created by the Department of Commerce. The PMI has become a widely used and reported economic indicator because it has a strong history of anticipating manufacturers' profits well before other economic reports. You can rely on the PMI to foretell the economy's turning points. Remember, the PMI is a composite index made up of 5 of the ISM report on business indexes, equally weighted and seasonally adjusted. The 5 indexes are as follows: the New Orders Index, the Production Index, the Employment Index, the Supplier Deliveries Index, the Inventories Index. Salute, appreciate everybody for tapping in, man. So, let me plug this phone in. So remember, when manufacturing represented a larger percentage of the U.S. economy, a PMI reading of below 50 meant that the U.S. economy was heading for a recession, although that reading still indicates that the manufacturing portion of the U.S. economy is declining. ISM now estimates that a PMI value below 42.5 corresponds to a contraction of the whole economy. Still, a strong correlation remains. The PMI, the US GDP, see Chapter 7, and the business cycle, Figure 10.2 illustrates this relationship by showing the value of the PMI over time, with periods of economic contraction shaded in gray. In addition to the PMI for U.S. manufacturing, ISM also provides a PMI for global manufacturing. It's published in conjunction with JP Morgan, and you can find it on the ISM website listed in Table 10.1. I discussed this global PMI more fully in Chapter 17. Monitoring market movement. Investment markets are very sensitive to changes in the manufacturing ISM report on business. Although equities markets, bond markets, and commodities markets may focus on different aspects of this report, they all share an affinity for these purchasing manager survey. The following sections explain how the different markets react to the report on business. So, seeing stock market reactions to the PMI. Unexpected PMI changes trigger immediate trading activity in the stocks of both manufacturing sector companies and the market as a whole. However, investors are equally interested in the industries that reported growth or decline in specific indexes, see Figure 10.1, as well as the overall performance by industry, summary at the beginning of the report. Broad-based indexes like the PMI rarely represent the condition of every industry or sector. Some industries lead during an economic expansion, while others decline during the same period. For example, falling oil prices are rarely good news for oil refineries and gasoline retailers, but they're great news for the transportation industry or any sector that incurs high transportation costs when moving its products to market. Falling oil prices also favor industries with high energy requirements, such as steel mills or aluminum foundries. So a tip, if you're an equity investor, you need to pay close attention to both the PMI and the sub-indexes. A trend of rising PMI values usually corresponds with a growing economy, which is usually good for equities. The strength of a specific manufacturing sector can help you identify investment opportunities and the current state of the business cycle as well. Detailing bond reactions to manufacturing expansion. The way bond investors react to manufacturing sectors' growth is almost exactly opposite. Let me say that again. The way bond investors react to manufacturing sectors' growth is almost always exactly the opposite of the way equity investors react. Economic growth leads to rising interest rates, lower bond prices, and sometimes inflation. Inflation is never good news for bondholders because it makes interest payments less valuable. So remember that. That's something that the book keeps driving home. So salute. Drop a comment if you just pulled up on the shout out to Jason Brown in the building. So another tip. Bond investors track both the PMI and the sub-indexes that can indicate either current or future price increases because they offer an early hint that inflation may become an issue. As prices rise, bond investors need to shorten the duration of their portfolios. Long-term bonds are much more sensitive to inflationary pressures than short-term bonds. The prices index is obviously the first place to look for insight into the future price increases. Both bond investors and also monitor the backlog of orders index, the supplier deliveries index, and the new orders index. So digging for insight into the commodities markets. ISM surveys of purchasing managers help commodities traders identify manufacturing materials that are in short supply and provide some insight into current and future demand. So this information helps with people that are also trading options. Like if you can identify, which products are short, in inventory, you can start to make plays determining on that, or you can see, which inventories are piling up. You can also determine like, okay, most likely these companies are, going to be heading towards a downturn. So, you got to connect the dots with this information and see how it applies to you and what you already learned. So, shout out to y'all pulling up on this free 99 info for those that caught it live on the stream, because later on it will be, other. So, gauging non-manufacturing companies. Manufacturing represents about 20% of the U.S. economy, so the creation of the economic indicator to measure the remaining 80% seems reasonable. The ISM has done just that with the non-manufacturing ISM report on business. This report is commonly called the ISM Services Report, or just the Services Report. It was first published in 1998, and like its manufacturing counterpart, is based on surveys of purchasing managers in non-manufacturing industries throughout the United States. Also, the manufacturer's report, it creates diffusion indexes. See Chapter 2 for more about diffusion indexes. To report changes in the current month's data compared to the preceding month's data, Table 10.2 gives a quick overview of this report. So monthly, the release schedule is monthly, the third business day of each month. Agency that releases it is the Institute for Supply Management. Its web address is ism.ws/ism report/index.cfm. Its sensitivity is low but growing, so keep that in mind. Like the manufacturing ISM report, the services report provides a performance summary by industry, anecdotal reports from the survey's respondents, a section about commodity pricing and availability, and indexes for a variety of business measures. Most of the sub-indexes are the same for both reports. However, the service report doesn't include the production index or the PMI, and it contains several indexes not included in the manufacturing report. Here's a brief explanation of the additional indexes. So non-manufacturing index, known as the NMI, this new composite index was first introduced in 2008. It serves as an indicator of the overall economic condition for the non-manufacturing sectors, and its service report, let me say that again, it serves as an indicator of the overall economic condition for the non-manufacturing sectors and is the service report's counterpart to the PMI. The NMI is an equally weighted composite of the following non-manufacturing diffusion index: the business activity index, the new orders index, the employment index, and the supplier deliveries index. The NMI doesn't have a long track record, but I expect it to gain more influence as investors become more comfortable with it. Of course, service industries aren't as economical sensitive as manufacturing industries. Still, the NMI offers investors a tool to monitor the health of this large business segment. Business Activity Index. Prior to 2008, this index was the headline index for the service report. It measures the change in business activity of service sector businesses. Inventory Sentiment Index. This index measures whether survey respondents believe that their inventory levels are too high or too low. An index above 50 indicates that respondents believe that their inventories are too high. Below 50 indicates that inventories are too low. And a reading of 50 means that inventories are just right. So the commodity pricing section of the services report also differs from its manufacturing counterpart. Few of the listed products are traditionally considered commodities, but they do impact pricing and profitability in the non-manufacturing industries. A few examples of the listed commodities include airfares, beef, cable products, capital equipment, coffee, consulting services, dairy products, and electrical and energy supplies, among many others. So remember this: the non-manufacturing ISM report on business receives little attention in the markets. One reason for investors' no-hum response is that services aren't as sensitive as manufacturing companies to changes in the business cycle. Nevertheless, investors can benefit from the details in the non-manufacturing ISM report on business, including the NMI composite. It's likely to become a more important index as traders, investors, and business leaders become comfortable with it. Salute 49KT said, makes so much sense. Essence said, this info is fire. 49KT says, sticky notes on deck. That's how you do it, man. The most things that stick out to you, make a note of it. So that way you can add it to, your repertoire of information that you have. So let's keep it moving. Looking at the leading economic index. With a name like the Leading Economic Index, or LEI, you may expect this indicator to be the perfect economic forecasting tool. It's not. Of course, there's no such thing. However, it does consolidate a great deal of existing economic data into a single, easy to understand index. If you're looking for a quick shortcut to analyze the current state of the business cycle and the general economy, or to confirm the analysis you've already done, consider giving the LEI a look. The report is freely available, and Table 10.3 gives you an overview. So it's a monthly release schedule at 10:10 a.m. Eastern Time. The agency that releases it is the Conference Board. Their website is www.conference-board.org/data/bci country.cfm?CID = 1. Its sensitivity to the market is low. So you can find the publication date for the next release of the Leading Economic Index in the technical notes of the current release. The technical notes are linked in the upper right hand corner of the website listed in Table 10.3. The idea to create an all-encompassing index has been around for a while. The LEI was first published by the U.S. Department of Commerce, but was privatized in 1995 and transferred to the Conference Board. The LEI is one index in a trio of simultaneously published indexes. In addition to the leading economic index, the Conference Board also publishes the Coincident Economic Index, or CEI, and the Lagging Economic Index. All three are composites of existing economic indicators, but the LEI is the one that interests investors and business leaders the most. The composition of indexes that the Conference Board uses to calculate the LEI is periodically updated. Currently, the LEI is a composite of the following economic indicators: average weekly hours, manufacturing, from the Employment Situation Report, see Chapter 4 or Class 2. Average weekly initial claims for unemployment insurance, from Unemployment Insurance Weekly Claims Report, you can see Chapter 4 or Class 2 for that. Also, manufacturers' new orders, consumer goods, and materials. You can see the full report on manufacturing shipments, inventories, and orders in Chapter 9, or in this class in the beginning. Also, we got the index of supplier deliveries vendor performance from the Manufacturing ISM report on business reviewed earlier in this chapter. Manufacturers' new orders, non-defense capital goods from the full report on manufacturers' shipment inventories and orders, see Chapter 9. Building permits, new private housing units from the Housing Starts report, see Chapter 11. Stock prices, 500 common stocks, the Standard & Poor's S&P 500 index of large company stocks. Real money supply from the Federal Reserve's money supply report, see Chapter 8, or I believe that was our last class, that's Class 4. Interest rates spread, 10-year treasury bonds, less federal funds, the difference between the market rate for 10-year treasury bonds and the federal funds rate. Check out Chapter 8 for information about the federal funds rate. See Chapter 14 for more about the yield curve and interest rate spreads. So if y'all paid attention, y'all, in the current market today, y'all will see that we had the Federal Reserve Chair Powell, Chairman Powell, being questioned by Congress. I believe that was Elizabeth Warren, if I'm not mistaken, that was questioning him on, how is raising the federal funds rate going to lower prices? And he actually told us that, it's not going to really lower prices. It can help, try to curb inflation. So, that's what they're talking about right now. So this information that we're reading, even though it's historical information, this information comes back around. This is the information you need to understand to how to determine where we are, like they call it in the book, in the business cycle or in the market cycle, to understand where things are, when things are starting to turn around, when things are picking up. All this is important. So Index of Consumer Expectations from the University of Michigan Consumer Sentiment Index, see Chapter 5 or Class 3 for that. So you can see the performance of the leading economic index and coincident economic index in Figure 10.3. As you can see, the LEI turned down well in advance of the two recessions shown in Figure 10.3 and turned up before the two recessions were complete. The CEI showed similar movements, but the timing of the motion coincided more closely with the start and finish of the economic contraction. Although these indexes do what they're intended to do, they don't get a lot of attention from investors. The problem is that most of the data used to calculate the LEI is already known before the composite indexes are released. From Wall Street's perspective, the lack of timeliness makes the LEI announcement anticlimactic. Another problem is that not all the data used to calculate the composite are available when the index is published. The Conference Board must estimate several of the indicators used in the report, which doesn't improve LEI's attractiveness for investors. In short, investors don't pay close attention to the LEI release. So here's a graph of that, and then at the end we got, nevertheless, the LEI has a pretty good track record, and it may be useful. It may be a useful tool. Taken together, the leading, coincident, and lagging indexes provide a useful look at the economic situation and the current business cycle. As long as you don't expect perfection or market-shaking results, these indexes are worth a look. So here's the Conference Board's leading economic index, or the LEI for the U.S. edges up. So here's a look. It ranges from a low of 80 to 116 right now, and we're seeing okay, so these gray areas are basically the pullbacks, what they were talking about, how it matches up with the downturns in the economy. And then on the other hand, we have how it matches up with when things begin to turn around in the economy. So this is called the Conference Board Leading Economic Index. So I'll show y'all a picture of this so y'all can just get familiar with what it looks like. You can Google the most recent one, but just really want to get y'all familiar with some of these things, so when you decide to do more research on it, or you hear about it being talked about in the news, you understand what they're actually talking about. So that's shout out to Pac-Man Kales pulling up on this, getting this info. So that's chapter 9 and 10, which is technically we do 2 chapters each class, but that one was pretty short. Most of our classes go about 2 hours, 2:30, really around 2 hours and 30 minutes, but so far we're only at 1 hour and 19 minutes. So this next chapter is spending on housing and residential construction. So let's take a look at the time real quick and determine if we're gonna go into this one. So let's see. Okay, we'll wrap it up with those 2 chapters because I really don't want to overwhelm y'all. I want y'all to be able to really, consume this info and retain as much of it as possible. So I don't want to just slam too many chapters on top of y'all. So, take this information, if you want, you can play some of these portions back that you possibly missed, or some things that you want to get a better understanding on. But this information is very, very important, y'all. It's all playing out in front of us right now. So, SHIB constantly moving up right now. We're up 13% at the moment. So, like I told y'all earlier, we're going to test this 12 range here, and then possibly the 14 range. All you got to do is go back and watch my videos, the earlier videos from the day. You want to watch all the videos that I drop in a day, because I'm releasing different gems, releasing different information inside of these videos to help y'all navigate these markets and know what to do. But that's all we got for this class. I'll take a couple questions if y'all want to know. If y'all got any questions for me. Salute. Take this time to become a channel member if you haven't already, and you want to really rock with us to another level and get access to some of the members only content. Again, some of this information, like these classes, will be moving to the members only section, where only members of the channel will have access to this information. Y'all that pulled up on the stream live, y'all get the information because y'all took the initiative to pull up on time, but after this, it may be members only, and eventually this will be course level material. This is college level material that you have to go pay, a tuition. You got to pay, get in debt with this degree to learn this level of information. And, I'm getting y'all the most important information without any fluff. We don't got any random electives that we got to go, absorb or pay for. We getting straight the facts that we really need to become better informed investors. That's why this name of this class is called the Class of Better Informed Investors. So we will not only be talking about economic indicators in this class, we'll be talking about financial planning. This is real. Imagine, making all this money investing and you don't even know, how to diversify or, how to really plan your financial future. So also technical analysis for trading and learning how to, day trade. I really want y'all to, have the opportunity. Not saying y'all got to become day traders or speculators, but I want y'all to understand what traders are doing so you can, not be one of the people that are stuck holding the bag and wondering and telling everybody stop selling. That's extremely rookie. When somebody's telling everybody, hey, stop selling so the price can go up. Obviously you're new, because you got to understand, some people are not here for the long term. They're speculators. They're trying to make profit daily. Some people invest every single day and never leave any of their money in the market. Let me tell y'all that again. Hold on, let me pull up on big screen so y'all can really hear me. But some people invest daily, and I'm talking about hundreds of thousands of dollars to millions of dollars each day, and they never leave any of their money in the market overnight. So they'll take this amount of money that they have to trade with for the day, they'll trade, and by the end of the day, they'll close all their positions and start fresh again tomorrow. So they're not carrying any crypto overnight. So, I want y'all to have this information so y'all understand what other people are doing, so y'all not caught, basically holding the bag, if that wasn't your idea to do. If you're holding for long term, that's different. That's a part of the strategy. But for those that were just buying, hoping to see some profits and was like, man, I should have took profit, this information teaches you, when to take profit. and it teaches you how to learn how to do this on your own. So that's all we got for this class. Appreciate everybody for pulling up. It looks like that's all we got for questions. Shout out to everybody tuning in after the stream as well. Make sure y'all